Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And it is again this time of the quarter when we have our Chief Investment Officer, Mr. David Czarnecki, on with us to give us his perspective on just what happened in the world, what happened in the economy. Maybe we'll be able to figure out what may happen the next, but we won't. We won't pretend to predict anything here for what the world holds in store for us. David, welcome.
Thank you, Paul. Good to see you.
Great to see you. Yeah. Look, a lot of continuing themes, I think, this quarter, but a lot of change has happened. I think since the last time we recorded towards the end of last year. And why don't we just start with the first one, China. China continues to be in the news, and it's a lot of things on sort of the political front, but economically, I've read a lot about the slowdown of the economy, particularly in the real estate market. And how is that going to impact us, either in the equity markets or with interest rates?
Yeah, it's definitely a big story, Paul. It continues to evolve, as you mentioned on the political front. While I don't typically get into politics, there are obviously economic implications to our relationships with the country. They do seem to be thawing just a teeny tiny bit. I mean, they're sending pandas back. I'm very excited about that. I'm a big fan of pandas myself. And but no, seriously, the China situation is a challenging one. Obviously, we've seen a lot of news and a lot of press about the economic situation there, the deterioration, the much slower growth, maybe even contraction if you kind of did the math the way we do it here. And so, and that has implications. It's having a little bit of implication for the equity market, although obviously the U.S. market is going gangbusters. It's having implications for global growth. It's having implications for commodity pricing and things of that nature. And it has implications for the U.S. debt markets. As we've spoken before about sort of this symbiotic relationship between China and the U.S., and China's growth historically has done a number of things for us and to help us. China has spent decades exporting deflation. They're not really doing that anymore. And so that is an overhang, if you will, to the inflation story, which we've talked a lot about. China's growth has led to very large reserves. And where are those reserves gone? Well, they've gone into the U.S. Treasury market in part. And that has been a big driver of the fall in rates over the last several decades in the United States. Now, we've seen a bit of a snapback in rates caused very specifically by inflation. Although we snapped back from what was an artificially low level. So, and as a result, if China continues to slow, the demand for U.S. Treasuries could come down. Again, China can't, we've talked a little bit about this, but China can't really boycott the Treasury market. It says no place else to put its money, number one. And number two, it would kind of be shooting itself in the foot. But less demand is less demand, particularly at a time, Paul, when the United States government is likely to be issuing an awful lot of debt, given the level of the deficits. So you've got this sort of double whammy of China having maybe a bit less of a bid for U.S. debt, and the U.S. needing to fund more debt. More supply, less demand, right? That economics 101, not a good situation for us. So I think, and the other thing we've talked a little bit about, Paul, is I've joked before about how, we used to say when the U.S. sneezes, the whole world catches a cold. And I think that's very true for China, too. And so Chinese demand, Chinese exports, Chinese supplies impact global demand and global GDP. And a slowing situation in China will continue to have impacts. The U.S. has been an outlier the last year or two in its growth relative to the rest of the world. That's great. And I'm happy we're here and I'm happy we're doing that. But obviously, in an interconnected global economy, it is hard to remain an outlier for a really long period of time. So it's a harbinger of, potential impacts on our own GDP and perhaps a slower growth backdrop for that. So we are worried about it. The Chinese economy is different than ours, and we're not likely to see the kind of debacle that you saw in the U.S. in, say, 2008, because it's a controlled economy, and so you're not going to have sort of the banking system puking out all of its real estate debt or something like that. They'll make sure that doesn't happen. So a cataclysm is not likely, but definitely it's at a minimum a dark cloud. What we call in the markets a big overhang and a headwind to GDP growth, to rate reduction, and to economic growth, on a global scale.
Oh, interesting. Well, maybe we shift gears to energy. And wow, does that feel like it should be connected, or energy prices should be connected with the rest of the world? But over the last few months, we've had attacks on shipping lanes. We have two major conflicts raging. At the last time I went to gas pumps, the prices are pretty much stable. They're pretty much where they were, maybe feels like in September last year. What's happening here?
Yeah, so I hinted at this when I was talking about China and slowing growth for commodities, oil being, of course, the largest of all commodities and the most important of all. And I think that is a factor. Yes, the shipping lane problem, the shipping lane situation is a problem, both from a geopolitical standpoint and world stability standpoint, but also, also from a commodity standpoint. So much goes through that channel, and clearly it's not going there, and so there's costs associated with it, slowdowns. Again, you're mucking with supply in one way, shape, or form.
Interesting.
So why hasn't it really played through? I think both China in particular, but to some extent the rest of the world, are factors here. As I mentioned, the U.S. has been a bit of an outlier in its growth. And we are, a fairly significant oil consumer, but we also produce, a fair bit of our own these days. But that doesn't matter so much because oil is a global commodity. Demand in China is down, slowing economy. Demand in Europe is down, slowing economy. We've had unseasonably warm weather, both here in the States for those of us, in the Northeast, but also in Europe. And so demand for, heating oil and things of that nature down, although Europe's predominantly gas, but it still affects. Those markets are interrelated. So, and with the U.S., while our growth hasn't slowed, there is an expectation that it will come off this year. All the forecasts are for a lower growth, which is why, people are expecting lower interest rates. Part of the reason why people are expecting lower interest rates. And so the market's kind of pricing that in and saying, well, we think demand's going to soften a bit in the U.S. It's softened a lot in China. Goods demand globally is down. And, obviously, petrochemicals are a big input to manufacturing. So, it's really a demand story, I think, in the end. And yes, the supply chain disruption probably has contributed a little bit to where oil is, so maybe it'd be a little bit lower. But it's really the story of sort of current and forward-looking demand.
Yeah, well, we've talked about inflation. It's kind of a nice segue. Energy certainly is an important component in inflation. It seems to be coming down. Mm-hmm. Now, the Fed targeted this a 2% inflation rate. I'm not sure why. I mean, I guess if we had a 0% inflation rate, it would suggest we're not growing. So, presume they want the 2% to keep the economy going. What's keeping them from achieving that rate? Is there anything in our way economically from us getting there sometime in 2024?
If you'll recall, Paul, that at its peak we were in the 9% area of inflation, and 3-ish% is where we are today. Is a heck of a lot lower than 9%, and people are feeling pretty good about the trajectory and where we're getting to. It does seem that I guess plateau is not the right word, but kind of flatlined a little bit. And we call this the last mile, and it's a little bit like Heartbreak Hill in the Boston Marathon, where it's a tough hill to climb. Why is that? Well, there are a number of factors. First of all, where we saw the most significant and rapid drop was in goods deflation. A little bit of that, Paul, I hate to use the term, but if you remember back when all this started, the Fed said inflation effects are transitory. It was because of the pandemic. It was because of the breaks in supply chains. It was a rat moving through the snake, so to speak. Well, they weren't right about that, but they weren't 100% wrong either. There were dislocations, there were problems, and those were the easiest things. The first part of getting rid of inflation was just cleaning that up. So that was a big chunk of it right there. And then goods demand has come off. We just talked about what's going on in China and Europe and other parts of the world. So goods demand is generally down. So that's put some pressure. But we also had some activity during this time period, Paul, that's what we call stickier, a lot stickier. And you have to remember the U.S. is now predominantly a services economy. If you look back historically at the way services prices play out, and this has implications for inflation and recession, is goods prices will tend to be a bit more volatile. You'll have inflation, they'll go up. You can have hyperinflation or whatever, and you can get them back down by adjusting supply and demand. Services is a little bit different. You tend not to have full-on services recessions. You sort of have more of a soft landing in services, but services pricing tends to be sticky. Cases in point, the auto workers, right? They've just, renegotiated some fairly hefty contracts. Those aren't getting repriced anytime soon. Those salary increases are there to stay. I haven't seen any professional sports players whining about the cut in pay that they've been taking. So I think that's here to stay. You saw UPS have to renegotiated with its drivers, and they're taking a whack at middle management to offset some of that cost. It's going to cost Boeing more to make planes, that's for sure. And so you have this very, very sticky part of inflation that will take a while to get down. I think you've seen in the last few weeks very loud signaling of that. We saw CPI and PCE, the core indicator that the Fed really likes to watch, come in not higher than expectations, but expectations are still elevated. It's still above where we want to be. So a little bit of a negative trend there. There was a lot of talk that the Fed was going to do its first cut in March, and then, maybe May. You're hearing this week the Fed is starting, and pundits are starting to talk about later this year. You've even seen a couple people come out and say, maybe not at all this year. Jamie Dimon spoke at the JP Morgan High Yield Conference last week and flat out said, I don't think we're going to get this last bit of inflation down anytime soon. And I don't think they're going to be cutting rates anytime soon. So we're sort of in this environment where what the market calls it is higher for longer. I don't know that I'd call 4% high. Certainly a lot higher than zero. I don't know that I'd call it high. But we are elevated. It will be very difficult to squeeze out this last bit, particularly when the U.S. economy is still running at full employment. One of the big areas of inflation is wages, and the way wages come down is unemployment, basically. And the Fed has done a good job of avoiding that, and that's part of its job. But that means this last bit is tough.
It's surprising, David, where we are right now, considering where people thought it would be, a year ago. Right. I think the outcomes have been much, much more positive than I think a lot of people would have expected. We talked about a little bit about the global conflicts. Again, we've been remarkably insulated, it feels, economically from what's taken place. Is there anything that could change? If these wars keep going on longer than expected, there's more disruption, in the Middle East of some sort. What point is there a signal that, maybe all these assumptions about soft landing will evaporate? Yeah.
It's always tough to call the lightning bolt, right, Paul? But a few things. Obviously these two major conflicts that we're talking about, Russia and the Ukraine. and in the Middle East, just a horrific human toll, right? Sadly, the effects on the global economy are more muted because these tend to be somewhat smaller economies. Israel is actually a decent-sized economy for its size, and Israel has it's important to the global economic system because of a lot of stuff that is produced there or created there. They sort of punch way above their weight, but the pressure isn't in Israel. Where the disruption is sort of in the Gaza Strip, so it's not affecting the Israeli ability to kind of produce goods and services as it has before. So the long story short, Paul, is that as sad as it is, to admit this, economically it's not that big a deal. Now, you said what could? Well, extension of these conflicts. If other things were to get drawn in, I mean, we heard, or at least indirectly heard, Putin the other day, threatening the world. If something, more dramatic were to happen, and I'm not talking about a nuclear, nuclear activity. I'm just, what if it extends beyond the borders, and NATO does get drawn in? Now, you've got an economic impact. You've got a shutdown of the world order in terms of flows. We talked about the flow of goods earlier, Paul. In the shipping lanes, that's modest compared to a real drop in world trade if countries are to line up on one side or the other and start to get strategic in their trading. I mean, we're still almost all economic in our trading, and so those would be your big concerns. We certainly don't want to see either of these things, go on and continue. Because obviously the human toll is just horrible, but unfortunately the economic toll is more muted, and I think the market is generally looking through that, and that's why you're seeing, it hasn't had that big an impact on global GDP.
Yeah, well, there are reasons to be optimistic. I saw that Iran, I think, diluted some of their uranium, I think, which was an interesting signal.
Yep.
You mentioned pandas coming back to the U.S. I thought we were going to be pandaless for many years here,
right?
And I think we'll work. I think we'll work through these issues. But again, David, thanks for your time. This is terrific. We enjoy these quarterly talks. Hope our listeners gained quite as much as I did from this. And for our listeners, listen, share the show. Tell your friends, and certainly give us comments. And just make sure to tune in next week for another great episode of That Annuity Show. Thanks.
Thank you, Paul.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.